Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Sanjana Prabhakar. She is the Index Research Specialist with Nasdaq Investment Intelligence and joins us for Cybersecurity Awareness Month to discuss the ISE Cybersecurity UCITS Index, which is designed to track companies that are actively involved in providing cybersecurity technologies and services. Sanjana, it's great to see you. Welcome back to Trade Talks.
Hi, Jill. Thanks for having me back. Doing a quick check-in on the fundamentals of the ISE Cybersecurity UCITS Index, ticker HUR, which is designed to track public companies that are actively involved in providing cybersecurity services. So very quickly, before I dive into the fundamentals, a quick snapshot of the state of the industry as it is today. Today, cybersecurity is not merely a technology risk, but a business risk. And when a risk to business continuity emerges, it sort of ascends the hierarchy of business needs and quite often spurs additional investment in sophisticated solutions. And what we have seen is in the recent months, both industry experts and tech vendors have been regularly commenting on the resilient nature of cyber spending. And in fact, surveys by leading firms such as Gartner lend sort of credence to the story that cyber is now a business essential, unlikely to be cut even in a recessionary environment. And that's something that we wanted to flag. And if you look at the recent performance of the AQR index versus other broad-based benchmarks, you see that the index was up about 9.3% versus the Nasdaq 100 up 6.6% and the S&P up 4.4% for the month of July. And we saw similar outperformance for the month of August as well.
Great. So let's pull up your first slide here and take a look at revenue and earnings and the correlation to performance.
Sure. So we're looking at two fundamental metrics, as you mentioned, revenue and earnings and its correlation to performance. So if you can see the chart to the left, you see that the index is tilted heavily towards those companies with revenues forecasted to grow, with close to 80% of the index weight tied to companies with revenues forecasted to grow. And these companies are outperforming companies with revenues projected to decline by an average of 8 percentage points. And if you look at the most recent quarter, a sizable number, 32 out of 45 companies actually grew their revenues by double digits, 26%, due to very strong demand for cybersecurity products. And this is despite headwinds in Asia, the supply chain challenges that we have seen and fluctuations in buying patterns. And if we look at the rest of the year, the outlook for revenue growth is largely positive, again, due to cyber now being a must-have versus a nice-to-have. And if you look at the chart to the right, there is a disconnect when comparing the performance of HUR constituents with earnings growth growing at the fastest rate, that is greater than 100%. Versus all others. So on average, these names were down, as you can see, 42.5%, whereas those companies with earnings growing at a slower rate, less than 100%, were down only 19.7%. And most tellingly, companies with negative forecasted earnings were down 29.8%. So what this disconnect implies is investors have perhaps been a little pessimistic about some of the higher growth names, and wanted to flag that given that most index constituents have reported earnings through the first half of the year and have actually updated their guidance at least twice, there is a possibility for recovery in index performance that we observed in July and August.
Let's move along to margins for a moment here. Is this a strong margin business?
Yes, absolutely. Again, wanted to flag that the strong trends that we observed in revenues and earnings extend to these key measures of profitability, gross margin and net margin. And as you can see, the gross margin of most of the index, that is 36 out of 45 companies, are forecasted to grow in full year 2022, while gross margins of only 7 companies are forecasted to decline. And what this suggests is that top line growth, that is via new bookings as well as pricing power, is strong enough to offset some of the inflationary pressures that we've been hearing about from rising input costs. And if you look at the chart to the right, you see that companies with net margins forecasted to grow make up about 86% of the index weight. Again, it's tilted heavily to those companies with net margins forecasted to grow. And as a group, they were down about 26.8% year to date on average, and are underperforming companies with net margins forecasted to decline, again suggesting some disconnect between performance and fundamentals.
And how about free cash flow, particularly in a volatile market in 2022? Certainly investors are looking for healthy balance sheets, lots of free cash flow.
Absolutely. So as you can see in the next slide here, close to 36 out of 45 companies are forecast to be free cash flow positive for the year 2022. These companies make up about 78% of the index weight. And as a group, they're down 19.5%. Outperforming those companies which are forecast to be free cash flow negative. And as you mentioned, investors are focused on cash flow generation in today's macroeconomic environment. So it's quite reassuring to observe that vast majority of the index is sort of on track to meet this hurdle this year, despite the prevalence of younger, still fast-growing constituents. And if you look at the operating margin, you see that 39 out of 45 companies are forecast to grow, with 22 actually forecast to grow by double digits. So that's quite a sizable number. This makes up 91% of the index weight. And as a group, they're down 23.3% on average, outperforming companies with operating margins expected to decline. So again, what this reinforces is the idea that there is the index does have a cash generating ability, and in aggregate will perhaps improve going forward.
And finally, how about valuations as you think about multiples here?
So if you look at the way this year has played out, the index has actually become cheaper on a number of metrics, including price to book, EV to sales, and EV to EBITDA. And what we wanted to flag is that concerns around the macroeconomic environment and company-specific headwinds and sort of negative sentiment towards higher growth tech stocks in general have weighed more heavily on multiples this year. What is also interesting and worth noting is that while the index PE for the year ending 12/31/2021, so the previous year, was actually not meaningful, but for the year ending 12/31/2022, the PE is expected to be 38.5 after factoring all available consensus earning estimates. For those companies with positive earnings, the forecasted PE is expected to be approximately 22, which is quite well within reason compared to a tech-heavy benchmark such as the Nasdaq 100. And given that some of the newer companies in the high growth stage have more room to grow in terms of growth and profitability, they're likely to command an elevated PE ratio in the near term versus their more mature counterparts. And looking beyond next year into 2023, the latest consensus estimates anticipate that the entire index is likely to normalize at a PE of approximately 28.
All right, and to wrap up here, Sanjana, again, it's been a volatile market, but when you think about the overall fundamental picture for cybersecurity, just reiterate in the last minute here the investment case for it.
Sure. So we believe that the companies that make up the index have shown strong strength in fundamentals given how volatile the macroeconomic environment has been, and would like to conclude that there is a sense of cautious optimism among market participants due to a number of factors. And they are one, strong underpinnings, fundamental underpinnings of the HUR index, the defensive nature of cybersecurity spend, and the presence of global headwinds.
All right, we appreciate the insight. Thanks for joining us on Cybersecurity Awareness Month. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.